Hello, everybody, and welcome to our show today. So, for those of you that watch us live as we go on YouTube, my apology for being about 5 minutes late. For some reason, our scheduled recording would not go live, and they instead had me go ahead and start a new stream. So, here we are. We made it one way or the other. Sorry that we are a little bit late from our usual 1 o'clock Eastern start time, but technical issues, here we are. So today we're going to be diving in. We're going to be talking a little bit more about angel investing. A lot of people ask about angel investing, ways that you can get money even as a startup business through angel investing. And today we're going to decode this entire process, what angel investing is, how it works, where you go to get investors, all the types of details that you need to be able to lock down and secure angel investing. So for those of you who don't know me, my name is Ty Crandall. I'm actually the CEO here at Credit Suite. And if you have any questions along the way that we can help you answer, feel free to give us a ring. 877-600-2487, 877-600-2487. info@creditsuite.com, info@creditsuite.com. When we go live through YouTube, we do not have the ability to actually see comments in real time through Google Hangouts. So if you have any questions, give us a call or send us an email or go ahead and make a comment on the video, and we will go ahead and reply to the comment after our live stream. And also, you're going to see this link at the bottom of a lot of our slides. If you are watching live, creditsuite.com/get funding. That creditsuite.com/get funding is a great link to go to qualify for all different kinds of credit lines, loans, etc. So let's dive in. So when we talk about angel investing, it's important to know business financing really in general. We're talking about basically getting the working capital that you need to grow your business. And it doesn't really have to be difficult if you know the best place to go to get it. Well, a lot of companies nowadays are turning to angel investors. Angel investors have become one of the most popular ways out there to actually access money because with angel investors, you're basically exchanging a percentage of ownership in your business, and you don't need cash flow. You don't need good credit. You don't need collateral. You don't need any of the things that are needed for a lot of loans and credit lines that are out there today. So angel investing is very, very, very popular, especially for startups. And as we'll talk about today, if you're looking for money without cash flow, credit, or collateral, you can still get venture capital if you're an existing business. But typically, angel investing is where startups or newer phase businesses are going to go to capital, and then venture capital is more for established concepts. But there's a lot of things you should know about angel investing that we're going to be diving into today. So according to Investopedia, angel investors invest in small startups or entrepreneurs. Often angel investors are among an entrepreneur's family and friends. The capital angel investors provided may be a one-time investment to help the business propel, or an ongoing injection of money to support and carry the company through its difficult stages. So we're going to talk a little bit more about what are called affiliated and unaffiliated investors. And what this is referring to is angel investors coming from family and friends. Those are what are called affiliated investors, people that have an affiliation with you already. And then there's also what is called unaffiliated investing, which has to do with people you don't know that are just interested in investing in your concept. So the term comes from Broadway theater. Originally, that's where Broadway theaters got their money, was from angel investors. And angels were originally the investors who backed those plays, and they actually still do. Okay, they're all actually nowadays called patron of the arts versus angel investing. And then it was so successful with Broadway theater that it then really continued into a lot of different industries where we see it today. So who can be an angel investor? Well, it's not covered by the SEC, the Securities and Exchange Commission. So really anybody can be an angel investor that wants to be an angel investor. Now, a lot of them are called accredited investors, and an accredited investor is somebody that has a net worth of $1 million or more and an annual income of $200,000 a year or more. So what accredited means is you kind of already know that these people have the money to invest. Whereas any kind of unaccredited investor, somebody that hasn't went through and got this credential, it doesn't mean they're not a bad investor. It just means that they may not have this $1 million plus net worth and $200,000 a year in annual revenue. Nowadays, you're starting to see more unaccredited investors than accredited investors, and that's because of what are called angel networks. Angel networks are, well, they're really quite brilliant. What angel networks do is they take together a pool of people that can contribute smaller amounts of money. They pool the money together and invest into companies. So, for example, you can get into one of these angel investing networks. You could put in $500 or $1,000 or $2,000, much smaller amount than normal angel investors invest. And then they pool your money together with 5, 10, 15, 20 other investors in the network. And then you invest into one company for $25,000, $50,000. And your contribution's only $500, $1,000. It's a great way to go. So in those kind of scenarios, you're not an accredited investor, but still there's a lot of value to these type of groups, individuals, and networks, even if they're not accredited. But you should know what an accredited investor is. Now, according to Inc. magazine, Jeff Clavier was one of the most prolific angel investors out there. Invested up to $6 million in almost 20 different companies, and he's the founder of a seed capital company in Silicon Valley called Uncork Capital. So nowadays, there's even more prolific investors. And I just read a book, and I forget the gentleman's name, and I will probably pull that up while we're on here, that actually talked about angel investing. And he's a really big time investor in Silicon Valley too, as a lot of the bigger investors are located out of that area. And he's both an angel investor and an actual venture capitalist. And again, if you're not familiar with these terms, we will talk a little bit more about that as we jump in. And actually, it was Jason Calacanis. I can't pronounce his last name. Calacanis, and he's a really prolific angel investor nowadays as well. So who else can be angel investors? Well, a lot of these people are not millionaires. A lot of them could be your friends, your family, could be colleagues, could be people sitting on home equity lines of credit, could be local professionals looking to invest. So when you're talking about angel investing, the one thing you need to know is that it's not this mythological thing where all these people are sitting out there with these buckets of cash to give you money. There are some angel investors that are out there like that, and we'll talk to you about how to access them. But what angel investors typically are is angel investors are typically people that you know, accredited investors. They're people that actually know who you are. You have a relationship with them. And in doing so, that actually sets you up for success because they already know you. They already believe in you. You know, angel investors in venture capital, when people are investing in your money, they're typically investing in you. And if you ever watch the show Shark Tank, you see that all the time where a lot of the sharks will acknowledge, look, it's you that I believe in. And there's a reason for that because it's a certain type of personality that really are not everybody has it, but there is a certain type of personality that tends to grow more successful businesses than other types. And these are people that are just extremely outgoing. They're innovators. They have architect type of mentalities where they can think through and problem solve at really high levels. And when they get stressed, they literally almost calm down and get calmer. Their heartbeats actually slow down in stressful situations versus other people that have the exact opposite effect. And so what happens is a lot of people that are angels or venture capital, they're looking for these type of people. So people around you, if they know that you have the ability to be a good business owner, well, then they might be the first ones that you want to start with because nowadays, unaccredited investors, these investors that just put money in without knowing you first, these people a lot of times want to see that you have accredited investors. The way that they see it is that you actually, if you have people that you know that have contributed money, it gives you more credibility and more of a reason for them to then want to turn around and give you money. So again, affiliated angels are people that you know, their friends, their family, their coworkers, their managers, their employees, their customers, their suppliers, and maybe even our competitors. Probably not, but it is possible. So accredited investors, bottom line, are people that know you. They know you, so the understanding who you are and your ability, that type of stuff is basically out of the way. And then it comes to a point of them liking your idea or liking your actual concept. Now, unaffiliated angels are people that you don't know. These are the ones you probably think about when you think about angel investors. These are the people that are investors that just have money to invest and want to get a rate of return. Maybe they're area professionals. Maybe they're entrepreneurs. Maybe they're people that have had successful exits from other businesses, sold other businesses. They want to invest their time somewhere else. They're middle managers that are looking for better ways to invest their money, you know, and they're just straight angels. They're just straight angel investors where all they do is do angel investors. So unaffiliated investors are likely to obviously need more assurances from you. They don't know you. Affiliated investors, they know you. So unaffiliated don't. So then they have to believe in you. And then they also have to believe in the concept and in the company and your ability to do what you say you're going to do to give them a reason to actually invest in. So there are formal and informal investors, okay, and they're generally investing in the startup of a company. That's what angels do. So angel investors are not typically for established businesses. This is typically what's called venture capital, okay? Now, what they're typically doing is exchanging money for a percentage of ownership in your business. So if you're not able or you're not willing to give up percentage ownership in your business, which could be 20%, 25%, maybe even more, then this isn't the way to go. So you got a couple different options when it comes to getting money. You can get business credit, you can get loans, you can get credit lines. These things have interest that you pay, and you start making payments on them pretty much right away. So you have to have the money to cover the payments for any of that type of financing you may get. The great news is you don't have to give up equity ownership of your business. If you go with an angel investing, the benefit is you don't have to make payments on the money. So even in the startup phase, you can get you have the money you need to get your idea. The product may be created to get the idea off the ground to build the business, and you don't have that burden of paying those payments in the early stages. But the trade-off is that as the business grows, then you no longer are the sole owner. You have somebody else that's invested in the business. The other trade-off and the other thing to think about is as the business grows and you want more people to come in and invest, you've already given up a percentage of ownership of the business as well. So a lot of them are even investing now through investing networks or crowdfunding platforms. So there's a lot of different ways that technology now has made it easier for angel investors to do what they do. So what's the most profitable angel investment of all time? Is Google. So Jeff Bezos, which we're obviously familiar with Amazon, gave $125,098 investing at 4 cents a share. And I don't know what Google is today. It's insanely higher than that. It's hundreds of dollars. He also got in Twitter on the second round of funding. And this is why he's worth $100 billion today. So people forget this. People don't know that Jeff Bezos that started Amazon, a few interesting things. One, this was where he made a lot of his money. He invested money earlier on into Google, into Twitter. He made some very good decisions with what are called unicorns, these companies that are very rare, that really take off and make billions, if not hundreds of billions of dollars. And that helped him even get the money to be able to grow Amazon to what it is today. A lot of people think of Amazon as one of the, place you can go to get anything, or one of the biggest places to buy anything in the world. But a lot of people don't realize that Amazon started selling just books and in the early 90s. And in the reality, it took 20 years for Amazon to even make a profit. Amazon was up operating, figuring out their model for 20 years, 20 years before they even got to a point where they started making profit. And because Jeff Bezos had invested in Google as an angel investor and invested in Twitter as an angel investor, those things took off and made him so much money that helped give him the capital he needed to make Amazon what you know of Amazon to be today. So what sorts of risks do angel investors take on? Well, they're dealing with startups, and the majority of startups fail. If you ever try to get money for a business and you struggled, it's typically because banks don't want to lend money to businesses that are less than 5 years old, even less than 3 years old. And the reason for that is if you look at business survival curves, what you see is that if a business makes it past 5 years, their chance for surviving a long time is very good, or much better than if it was less than 5 years. The majority of business failures happen in the first 5 years, even less than 3 years. So angel investors by default are taking on a huge risk investing in a business, because the problem is they're investing in startups, and startups typically will fail. And if they fail, they lose their investments completely. So professional angel investors are looking for a few things that you need to know about. One, they want a defined exit strategy, and that's most important, meaning that they're not giving you money just so you can get the business off the ground. What they're doing is they're giving you money so you can get the business off the ground, grow it, and sell it, or do an IPO, initial public offering. It's going public. Okay, so Facebook went public, for example. So, and a lot of the bigger companies do. So you're going to do one or the other. You're either going to sell the business, or you're going to basically go public. When either of those events happen, that's where angel investors cash out. That's where angel investors get their physical money out of the business. So when you're going to pitch to an angel, whether they're accredited, somebody that knows you, unaccredited, somebody that doesn't, you need to clearly define the exit strategy of the business. Look, my goal is to grow this business to $100 million within 5 years. And then in 5 years, it's to be acquired. Here are some great target companies that potentially right now at this point, if the business was built, could acquire. Okay, that's what they're looking for. They want to know you have a defined plan of here's how much I'm going to grow the business every year. And then I want to exit at this point. And at this point, here's what I think we can exit at. Exit means sell the business. And here's who I think maybe even can buy it. That's what they're looking for, because that's where they get their money back. Angel investors aren't typically getting the money as your business starts to make money. They're not getting paid back. They're getting paid back when an end event happens, when the business is sold, when the business goes public. So they're going to want to know that you have a plan to make one of those type of things happen. Now, the effective internal rate of returns for an angel investor is typically about 20 to 30%. That's what they want to earn on their entire portfolio of companies that they're invested in, is about 20 to 30%. Okay. And again, that's much higher than they're going to earn with banks or most other investments that they have. And again, it's a much higher than equity return of what you're paying them is higher than what you're typically going to pay for a bank for financing. But the benefit is that you can get money from angels when you typically can't get money from banks and other financing sources. And again, you don't have to pay anything on the money that you're borrowing from angels until there's actually an event such as an exit. So angel investors can be ideal for entrepreneurs that are still financially struggling during the startup phase, because again, they can get you money when you're just not able to get money from a lot of banks and credit lines. So companies can connect to affiliated angel investors by just asking. And remember, affiliated are people that you know, right? So you can go and talk to anybody that you know about your concept. Put together a pitch deck, which is simply a matter of, a short period of slides that explains what your business is, the problem that it solves, what you're going to do to generate money, the time frame of when you think you're actually going to generate money, the growth, your projected growth of what you think you're going to do, revenue, profits, your exit strategy. Once you put together that kind of pitch deck, and again, you can do all kinds of research. It's awesome. You could even easily find pitch decks from companies like Uber online to see what theirs looked like in the early stages. And then there's also unaffiliated and angel investors, as we talked about, people you don't know. Either one of them are probably going to want to see some kind of pitch. Okay. And those people you're going to get to by cold calling, by advertising, by going to business brokers, by looking at these networking sites that we talked about, intermediaries. And I'm going to give you a bunch of different places you can go to get these kind of unaffiliated investors, starting with Gust. So Gust.com, G-U-S-T, is basically a database of investors, companies, and programs that can work for you to get money from angel investing. So again, you're going to have a business plan, you're going to have a pitch deck, you're going to want to have a basic structure of your business, what it is, how it works, the problem it solves, how you're going to generate money, how long it's going to take you to generate money, the kind of money you're projected to generate in revenues and in profits, and what your plan is to sell the business. You're going to want to have that kind of plan. Now, startups can also search for business plan competitions, because if you think about it, if you're an angel investor, business plan competitions are a great place to look. The people that are finalists in business plan competitions have a pretty good chance of succeeding with that business. So anything where you see business plan competitions is a great place to work as well. Now, if you're working with Gust, you can look up in different investment groups, which includes a profile with information on which industries they typically fund. This is important. You'll notice with angel investing that they typically do invest based on the industry that you're in. So angel investors that are going to invest in a software company are typically going to be different than angel investors that invest into financial services, for example. Okay. And you also can look up programs, include deadlines and basic information like the amount of money that they fund. So there's all kinds of information about that online as well. And you can also look up companies. You can include a profile where the founders can add basic data and a pitch video. And pitch videos are very important. Okay, so sometimes people want to look at a pitch video before they even consider actually having you pitch to them. And a pitch video is going through the slide deck, doing a presentation, getting them to know you and why they should invest in you in the concept, etc. Now, Gus gives the search for angel investors more organization, so it makes it easier for you to decide how you want to search for these and make it easier for you to find potential investor. But it's not the only way to find angels. Okay, so other ways to find angels. Well, Entrepreneur Magazine suggests sites like Funding Post and Ace.net. Two more places to go: Funding Post and Ace.net. Now, they also suggest trying every possible investor and keeping in mind that, when it comes to angel investing, you can get turned down 100 times, and it's the 101st time that you pitch that you actually get picked up, that somebody actually invests. And that's the thing to keep in mind, is that, look, if you want to succeed in business, it comes down to persistence. It comes down to diligence. You can't just expect to put together a good pitch deck, get yourself prepped, take the steps to find the right angel, and then pitch and then not succeed and give up. You have to understand that it could be 100 times plus that you go and you pitch and you fine tune your pitch and you hear what their feedback is and you hear their objections and you ask them that. If an angel investor doesn't invest in your business that you pitched, Ask him why. Say, hey, look, for just to help me in the future, what are some things I could have done better? And he gets some feedback from them and then apply the feedback. And then when you do that, the 50th pitch you make, you're well more defined than the first pitch you make. And you have a much better chance of locking that down. You've listened to the people's objection and you've come in and you've worked your product, you've worked your plan to make it work for what these angel investors are telling you that's a problem. Look, if you're dealing with seasoned angel investors and they tell you, look, here's 3 things I don't like, more than likely, if you don't change those 3 things are going to bother other potential angel investors. So as long as you continue to get feedback of what they might not like and you continue to make changes and improvements, then you have a much greater chance of coming in and actually being able to spread it and be successful. I'll give you a perfect example. A lot of people that are listening or watching are familiar with Yeti coolers, Yeti cups, right? So Yeti, I actually know somebody that had a potential to invest in Yeti early on, and they passed on the investment of Yeti. They passed because Yeti had a really small niche. They were catering to hunters. They were catering to sportsmen. And they had a really expensive product in a really small niche, which are not the type of things that angel investors want to invest in. Because Yeti listened to it through these pitches and got feedback and got turned down and realized that these were things they didn't like, they changed their pitch. They changed their view to be more broad. They had lower cost products people could get into. They all actually spread out, not just in the sportsman and hunting communities, but to everybody, people that had boats and people that go camping into all these other areas. And then as a result, they ended up getting the investment that they need, and they turned into a I'm pretty sure a multi-billion-dollar company at this point. So again, that's what angel investing, it's exactly how it works. You have to come in, you have to start with an idea, you have to pitch, you have to know you may get turned down, and then you have to then build from there, learn from it, and continue to do it. So according to Entrepreneur, from the order from the smallest enlargement of investor groups include New York Angels Inc., stepping over my words today, Alliance of Angels, they're out of Seattle, Pasadena Angels. So these are all basically groups that invest, are angel investors, so groups that you're going to want to look into. Now, there's also Hyde Park Angel Network out of Chicago, Band of Angels, and I can never pronounce this right, Menlo Park, California. You don't know why I struggle with that. North Coast Angel Fund out of Cleveland, Golden Seeds out of New York City, Golden Seeds LLC. So you'll see a lot of angel investing networks are out of California. Most of them are. A lot of them are then from New York. And surprisingly, there's quite a few actually from Ohio that are out there as well. Investor Circles out of San Francisco, California again. Tech Coast Angels obviously deal with tech out of LA, and Ohio Tech Angel Funds out of Columbus. So it's kind of interesting because I read a book on angel investing, and again, it is by Jason Calacanis, and I can never pronounce his name right, Cacanis. And one of the first things he said is, if you want to get angel investors, move to California, to Silicon Valley. I thought, well, that's pretty extreme, but he makes a good point. A lot of these people are in the same area in Silicon Valley. So if you're not going to move there, just expect to be doing a lot of traveling in the beginning as you're trying to get these angels to invest. So groups focusing on and requirements vary. Again, some only focus on startups, some focus on deeper stage, some focus on certain industries. So don't waste your time trying to pitch to the wrong group. Do your research on these groups before you come in to pitch. So angel investor versus VC or venture capital. So angels are not quite the same as VC. An angel investor typically, again, invest in an early stage or startup company. Startup means you're just getting it off the ground. You might not even have sales. You might not even have revenue. You might not even have a product created yet. Early stage means maybe you do have a product. Maybe you do have sales, but you're still early into the infancy of the business, figuring out your model. And again, they're all typically, as we talked about, going to want 20-25% return on the investment. Now, angel investors tend to invest less money and will also want less control than venture capitalists do. This is surprising. When I've looked into angel investing, what I found is that $25,000 is kind of on the high end. Now, don't get me wrong. There's people that put hundreds of thousands of dollars in as angel investors, but for the most part, a lot of people are investing at 5 to 25 grand. It's not very much money at all. They typically are investing way less money than venture capitalists who invest hundreds of thousands of dollars or millions. So venture capitalists capitalists, otherwise known as VC, will also give money to build startups, but they typically are going to want more established businesses. So if a VC believes a company has both high growth and high risk potential, well, then they may invest in an actual startup, although it's not really common. But what they're looking for is fast growth companies with an exit strategy in place. And venture capitalists will often look to recover their investment within 3 to 5 year time frame. Angel investors kind of give you more time to be able to recoup the money. VC wants it a little bit faster. And they'll also often want a larger piece of the company, if not a controlling stake. And they almost always want to sit on the board. So angels put less money in. They get started earlier in the process of you building a business. Venture capitalists puts more money in. They typically get involved later in the stage of the business after you're making sales and your product is produced, etc. And they're typically going to put more money in and want more control. They're going to want more say in what you do. They're going to more regulate how you run the business. They're going to want a seat on your board of directors to make controlling decisions of what you do in the business. Okay. So keep that in mind that, angel investing, good for startups, really early stage businesses. As you start to produce revenue, as you start to actually come in and develop your concept, that's more where venture capitalists come in. Also keep in mind, angel investors aren't going to step on your toe. They might want a monthly, or preferably from you, a weekly report of how things are going in the business, but they're typically not going to bulldoze you and get involved and try to take control. Venture capitalists want some element of control. They have more money on the line, and they may want to command some of the decisions that you're making and running the business. So angels, again, can be wealthy or not wealthy. A lot of them are accredited and they have $1 million in net worth. A lot of them don't. Most people that invest in the business aren't going to have that accreditation status where they have $1 million in net worth. And again, they may be affiliated, they may be unaffiliated investors. Okay, affiliated are people you know. Unaffiliated are people you don't know. And they're typically going to want a 20-25% return on their investment. They're going to want to make that money. So when you sit and prepare a pitch deck to get in front of angel investors, then what they're going to want, we've talked briefly about how to do that, then you're going to want to make sure that you have an exit plan that gets in that 20% return that they're typically going to want. And again, these are great for startups. If you're already a well-established business, angel investors typically are not for you, okay? But the good news is even as a startup, this isn't like venture capitalists. They're typically going to want a smaller piece of the company than venture capitalists do. They want less control. They put in less money. They get started early on, and they know what the risk is. Angel investors expect to lose 8 or 9 out of 10 times, and they're hoping that 9th or 10th time that they win, that it's a home run. So they know the risk of startups. And if you don't know the risk of startups, keep in mind, angel investors know going in that there's an 80 to 90% chance they may lose their money. And then they know there's maybe a 10 to 20% chance that they may succeed. It's very small chances for them. But still, as they build a portfolio, and a lot of them do, a lot of these angels are getting started. They're getting into networks first. And then they're putting more of their own money in. And they've got 2, 3, 4, 5, 10, 15 companies they're invested in. They understand that with their losses, they're hoping that the returns they get will well surpass the losses to be able to make 25, 30% or more on their money. And they really hope for those unicorns that are just absolute home runs, like Uber, like Airbnb, like Facebook, like Google, where they can make considerable amount of money in return. That's what their real goal is to do when it comes to angel investing. So again, hopefully this helps gives you some background information on how angel investing, what angel investing is and how it works. If you have any questions, feel free to give us a ring, 877-600-2487, info@creditsuite.com. And also, if you're interested in getting money, we don't directly deal with angels or networks of angels, but if you are looking for the loans and the credit lines and business credit, things you can get even as a startup, then feel free to give us a check out at creditsuite.com/get funding. That's creditsuite.com/get funding. Also, don't forget that if this made sense, then access our free training on our website at the top right of our page, creditsuite.com. You can access things like our Facebook link where we go live every week. And when we go live, we actually have Q&A. You can ask questions, we can answer questions, and then we put a lot of content out in other places such as Twitter, Instagram, Instagram, etc. So make sure you check that out. And again, if you have any questions, give us a ring. We'll gladly talk to you more about all the different types of financing you can get, even talk to you more about angel investing. 877-600-2487, info@creditsuite.com. Don't forget to like and subscribe if you're watching on YouTube, or give us a quick review if you're listening in on our podcast on iTunes. Thank everybody. Have a great day.